All right, what's going on, everybody? Just got to get the Discord connected, so give me a moment. Hey, what's going on, everybody? Happy Friday, huh? Hope y'all got some good plans. They don't even have to be good, just have some plans, huh? I don't know. I'm not going to do nothing on the motorcycle. I know that. It's too cold. There's been a lot of talk about the move yesterday and how a number of people really got their butt handed to them. Um, It goes without saying, but I'm going to say it anyways. It's happened to everybody at some point, and I don't want anybody to take it personally, right? Trust me when I tell you you're not alone. If you tried to go long on a day like yesterday, over and over and over and over and over again, and you just got stuck in this bias that you couldn't get out of, and you got beat down all day. It has happened to everybody. And if you're listening and you're thinking that has never happened to me, well, don't worry, it will. Give it time. If you day trade, sooner or later, you're going to get stuck in one of those ruts. And it's like a bad groundhog day where it just keeps coming at you again and again and again and again. And you can't help yourself until you look back later and say, what the hell was I doing? Believe me when I say I get it, because it's happened to me. Mine was during COVID, and I was still trading a strategy that I no longer trade called a gap close play. And this isn't a liquidity gap, this was an actual gap, where price closes at one level and the next morning it opens at a different level. Well, that was a strategy that I used to try to trade back in the day. The statistics on it are absolutely amazing. So we had gapped up really hard at the open and started to fall as we got into the open. And I just knew for sure we were going to close that gap. So at the first sign that it was about to go up, I tried to go long. Yeah, that didn't work, but I was early. I'll try it again. And every time that market looked like it was going to go up, I tried to go long. Basically, like what it looked like yesterday. Any wick to the upside, right? There wasn't one green candle by noon where on the day that I was trading. Of course, we had started falling right at 9:30. We didn't wait like we did yesterday. I tried to short it all the way into lunch before I finally called it quits and looked back at this absolutely amazing short day, and I thought, why the hell was I trying to go long this whole time? What a beautiful move it's been. So it happens, right? It happens to everybody. If it hasn't happened to you yet, then give it time. So how do you fix it? Right? It's okay to shrug and say, "All right, it happened to everybody, whatever." But how do you make sure it never happens again? Well, I mean, we can all go ADHD, ooh, I saw a squirrel at any point, but try to put some checks and balances in place. For me, I like to journal my work. If you're journaling each trade as you take it, then when you go to answer the question, why did you go long? Or, why did you get in the trade? And if there's nothing on the screen that you have to point at in your journal to say, I got in to go long because of this, if there's nothing there, well, that kind of answers the question. You're trading on a bias that isn't even proven yet. There's some other criteria that you can use. You guys have probably heard me say more than once at some point, if we're inside of yesterday's range, then we can't go anywhere, right? We're not going to do anything. If we're inside of our own Globex range, we're not going to do anything. So if you look at yesterday when we started to break down, by that point we were already in the RTH. So the range is, we have to get out of that before we can do anything else. When we get out of that to the downside, that is the trade. Then you had the Globex midpoint of yesterday. When you get below the Globex midpoint, that is the trade that you continue to trade to the next level and the next level and the next level and the next level. You're not looking for a reversal because you're trading to the next level. Then when you get to the low, it's the same thing. You're trading to the next level, to the next level, to the next level. In a lot of fib books, they will lay it out in that sort of an argument that as long as you're still above level A, you can't go to level B, right? So for an example, if this is where we were at, we're still in this range up top, we have to break this level before we can go here. And I know that that's pretty Captain Obvious at that point, right? We can't go down here if we're not underneath this. But you got to put it, you got to say it, right? Like, them's the rules. You got to say it. Can you guys not see my screen? Orale. Really? Let's try this all again. Well, how about now? Yay. I fixed it. So in the pivot trading world, there is these classic set of rules that talk about how each new level opens after you've passed that level, right? So if we are up here and we have not yet broke down, oh, that's big. Yeah, yeah, that's better. If we have not yet broke down, then this is not in play, right? Because we have no ability to get there. It doesn't owe us anything. We don't have any signal, no pattern, no setup, no reason to think we can go here because we haven't broke that. But once we do break that, this is the most likely target. Now, I don't want to like put percentages on things because that doesn't really fit, right? But once we break down here, we can start to ask questions like, hey, what's more likely? Is it more likely that we hit this or that? Well, we're under the pivot. And until we get back above the pivot, it's more likely we'll hit this and less likely that we'll hit that. Okay, that's what we want to try to do. Now, I'm not saying that that's a trade. Oh, we broke down, so let's do that. But that's more likely. So in destination trading, which is what I really love to do as a pivot point trader, what's my destination? 67.24. I now want to look for short opportunities that can aim me towards 67.24. A lot of people will preface that by saying, so, okay, it broke out. When do I get in? I need these answers, Sig. When do I do it? Do I do it on the breakout? Do I do it when the breakout closes? What about when the new one opens? Well, there's no wrong way to go. And the answer to any of those is sure, yes, why not? Because I only want the one that works. So which one of those works? Oh, they all do. Sometimes. You're never going to know this time which one of those you're supposed to use this time. Sorry. There is no way to know. this time which one of those you're supposed to use. But there are ones that I like to use consistently because they suit me as a trader. I don't really like the breakdown bar a lot of times. It's not to say that I won't trade it at all, but I don't like the breakdown bar. It's isolated, it's all by itself. It's the first one. We usually land in a pool of liquidity, right? And then it gets intra wick, intra bar. This thing popped back up, right? Like we all know it did. We can't see it now because it closed way down here and it looks really beautiful. Like it just opened and it fell and it closed there. And golly gee, Bob's your uncle. But we know that that's not what happened, right? It went up, it went down, it laughed, it cried, it had a party. And then eventually, at some point, it got way down here and it closed. So if you had tried to trade it as soon as it broke down and you put your stop above the highest part of that candle, you would have been good, right? Yay. But big days like this, that's a 10 point, 15 point run. It's a lot of move. It's pretty scary. It's moving fast. 11 points. So we know, that that's not going to suit everybody. It certainly doesn't suit me to just hop in as it breaks down, but you can because that's what the rules say. You can do that. Or when it closes and the new bar opens, you can do that. The problem with getting in when the new bar opens is that we had a swing high up here. And after a swing high, we expect wicks. This one didn't get a wick, but we expected one there. We expect these wicks. So why would I want to get into a new candle as soon as the new candle opens, knowing in my mind that it's supposed to have a wick, which means it's supposed to go up before it goes down because we just had a swing high. I don't want to get in on the new bar and then take heat on the wick. So what I like to do whenever I can in any situation, if the market is falling, I want a pullback. I really want a pullback because I want to, you guys know the phrase, right? Buy high, sell low, buy high. Don't do that, right? Sell high, buy low. I knew that was coming in backwards. So that's what we want to do. But you're not going to get a pullback on a red day like that when it just fell, and it never pulled back, right? But we know that that's not true. It really did pull back yesterday. The pullbacks were on smaller time frames and or they were just the wicks that we can see here. So I try to anticipate that wick. Trust me when I tell you, if you wait for the wick and there is no wick, it's going to run away without you. And you're going to be mad because you waited for a wick and you didn't get a wick and it just ran away without you. And then you're going to say, damn it, why did I wait? I should have just got in as soon as the bar opened. But if you don't wait and you hop in as soon as the bar opens and then it wicks and it stops you out, you're going to say, damn it, why did I get in as soon as the bar opened? I should have waited on the wick. That's the way it goes, guys. And there's absolutely nothing you can do about it. So if you don't wait and you hop in and it stops you out, you know what you do? You get the heck back in again. And if you do wait and it starts to run away without you, you can hop in on the run or you can wait for the next bar and try to get in on that wick. So at some point, the breakout bar closes. I like to mark mids. I really like mids when I can, right? I really like mids. If it doesn't give me a mid, fine, whatever. But I want one if I can. And even if I get it, it doesn't mean that I'm actually going to get in there. One, I'm not always that fast. Sometimes it's faster than me. Two, when it happens, I don't always like the way it looks, and so I'll wait. I don't think there's anything on my chart, right? I don't have anything showing. There, there's nothing here, right? It's just me candles, just me candles. So I like a pullback if I can get it. I'll take that pullback. If I can't, we already know the rules. We can get in on the run. I don't want to, right? I don't like getting in on the run. I want that pullback, some kind of pullback. Because even the mildest pullback will give you a level to put your stop above. Now, when it comes to spotting the pullback, that's a really great question. Because as much as I use the 5 minute to do my analysis, I don't trade a 5 minute. I trade on a tick chart. Now, I'm getting to the point where on TradingView, I'm either going to have to buy the tick chart data or I'm going to have to start getting comfortable trading below 1 minute candles. I don't want to trade below 1 minute candles, by the way. I'm just really not interested in that. But I am just salty on the idea that they want me to pay more just to have a tick chart. So I don't know. On the one hand, it doesn't really matter, that it's just a couple more bucks. Who cares? It's the principle of it more than anything else. Kind of like my issue with Ninja Trader when they want me to use their platform and then they don't offer me basic tools and then they want you to buy their platform and they don't offer basic tools. Why? Why would I buy your platform? Whatever. I digress. So a tick chart, like anything else, is going to help us try to understand what's happening inside of those candles because that's always the problem, right? I shouldn't even have zoomed in here yet. What There's always this problem. I'm on a daily chart and this big red bar here is yesterday's bar. Now I get it. It's pretty obvious. We're looking at a daily bar and everybody is going to say, "Why would you trade a daily bar? You can't see anything. Support, resistance, momentum, trend, intraday pullbacks. You can't see anything. It's one big fat bar." You're absolutely right. So maybe we should go to a 65-minute bar. Yeah, no, those big 65-minute bars, they're completely worthless too. So I need to keep going until I find something that actually works. Well, here's a 15-minute bar. Yep, nope, those are big, fat, ugly bars too. What about a 5 minute? Nope, same problem. So what happens when you get to a 5 minute and you still got these big, fat bars and you can't see a pullback? You got to go lower. That's the answer. The answer is go lower. Well, how low am I supposed to go? Low enough until you can see what you're looking for. We don't always know how low that's going to be. 5 minute is usually really good until suddenly it isn't. So when it isn't, it's time to go shopping. Try a two. If two doesn't have it, go to one. If one doesn't have it, go to tick charts or go to a sub 1 minute chart. 45 seconds, 30 seconds, whatever it takes, right? Because we need to see inside this really big fat bar and we can't. And those 5 minute bars were big enough yesterday that they were as worthless as a daily bar. You know what I mean? When you put it into perspective like that, the lights kind of come on. Like, yeah, they were kind of worthless, weren't they? Yeah, these big fat long bars where we couldn't see anything. Not a lot of help in a big old bar like that. Not to say that they're completely worthless, because even daily bars have a lot to offer, but not the granularity we needed to be able to see a pullback. I've seen a lot of talk about getting more tools. More tools. That'll do it. That's actually the wrong way to go. Adding more to try to spot yesterday is worse. Not spotting yesterday didn't come because you lacked the tools to see it. It was any other reason. And depending on how you traded it, you'll want to examine your reasons. But it can be because you saw the tree and completely ignored the forest. You got so ingrained in your own bias that you couldn't let go. You got into your feelings and got angry and revenge traded. You see all these other things. None of those would fix the problem of I just couldn't see it. Let's see. I gotta zoom in on it. Yeah, that's a nice pullback. That's a really good pullback. And it's on a 1 minute. Yeah, 1 minute's valid. You know, anything is valid, I guess. But my criteria for is it am I going too low? Right? Because we always want to have some kind of line in the sand that says that's about as low as I want to go. I don't want to go any lower than that. To me, it's a visual and it will look something like let's see if we can yeah, of course we can do it. I'm gonna put this at an extreme level. It's choking on it, but we'll get there. Yeah. That's pretty nasty, pretty ugly looking. This is like a 133 tick on the ES. And it's happening so fast that price is stalling, frozen, and then it moves again, and then it stalls, and then it moves again. I don't want to trade that, right? So you can go as low as you want, but at some point it's going to get so small that you just don't want it. If it's equities, you'll find a lot of gaps and just these really weird big wicks, or you'll get a lot of dashes where price didn't do anything and it'd just be like a dash and then a dash and then a dash, that sort of stuff. And that's worthless. So I think you'll know when you go too low. But there's no perfect answer because you need to be able to see the trade triggers that you're looking for. And I promise you, you see things in the chart that I do not. You do. You absolutely see things that I do not see. And I see things that you don't see. And we could both be looking at a 5 minute chart and we're still going to see different things. So you want to set that chart's time to a level to where your lights come on and you're like, "Oh yeah, no baby, now I can see what I'm looking for now." That's the spot. And the number might change because in the pre-market we get different volume than in the intraday. And if we're waterfalling to the downside, we are getting a different market than we normally get. So you have to be flexible and willing to change the time to match the moves to see the candles that you need to see. When I was newer, I remember we had this real big long discussion about getting comfortable on one time frame and mastering that one time frame because we could better recognize trade signals and trade patterns and drawings and all of that. And I'm still a big fan. If you guys notice, I've always got my 5 because my 5 is where I do all my work. It's just not where I do all my trading. My trading has to be flexible enough to allow me to jump into those different time frames to see a pullback in any kind of market condition. Yesterday's thing would not have been solved by those other platforms other than Bookmap and Jigsaw both run very small charts. The default chart on Jigsaw when you first start the platform is 10 seconds, but it's got a boatload of data that goes with that, right? It's got the cumulative delta and you can see all of the market behind it. It's a lot like Bookmap. And so, I mean, you got granularity at that point, right? You got 10-second candles. So maybe at the most, those sophisticated tools would have told you don't go long, right? But candles alone, if you don't want to go spend $1,000 and get those tools, the candles alone told you that there was no long opportunity, other than the bias that kept whispering to you that this reversal is going to be awesome. We just got to get the reversal. This is called one time framing, by the way, when it's a single candle color that never lets up. Here's another little tip that something is going wrong, and it comes back to my fib style. I was talking to somebody that had never met me before today, and they've been trading for a while, and they were asking questions about how I trade, kind of generically, like hey, are you a Elliott wave kind of person, or are you an indicator kind of guy? And like, I got my own custom use of quant and quadrant, and I just use these lines that are dynamic and move. And the guy just had this weird kind of spinning symbol over his head as his eyes glazed over, and he had no idea what the hell I was talking about. Pretty funny now that I think about it. Joe, you guys got access to so many different traders in here that you have so many different styles in here that I was talking to a guy with 30 plus years of trading experience, and he couldn't follow along on anything that I was trying to explain to him. Why? Because he only knew his own tiny little world and he hadn't been exposed to anything else. Diversification is pretty cool, that you can come up with so many different styles and then build something out of it that's unique to you. My fibs, if you had used them yesterday, gave a really awesome warning not to go long. Here's the warning. When we break out of a range, this is the range, by the way. When we're in a range and we finally break out, we are supposed to stop at 1236. That is not maybe, that's what we're supposed to do. And we ran right through that like it wasn't even there. Had this tiny little up wick, and then down we went. We just kept right on going. And we're looking for an OCC to move the drawing, right? That's one of the things we do. We hit 1236, we wait for OCC, and then we update the drawing. We couldn't update the drawing because we never got the OCC. It fell to the next candle, at which point we would have been waiting for an OCC and move the drawing. We couldn't move the drawing because we didn't get an opposite candle color. And it just kept going and kept going and kept going and kept going and kept going. You could never update the drawing. That's a huge red flag that you don't want to look for longs because we can't update the drawing because we're not getting an opposite candle color. Not once. Where's the profit taking? There wasn't any. Nobody took profit. It just kept falling. If they won't take profit, you can't get a long, right? Or a short if we were going the other way around. Now, I get it. A lot of people don't wait for the opposite candle. They don't wait for the confirmation signal. And we've talked about that, right? Waiting for signal, you pay for it. So why wait? The thing is, even if you weren't yet in the trade or you had already lost one or two at this point, we still need to update the drawing. And we had no chance to do that. Now it's real easy to look back and poke holes in theory, right? It's a lot harder to trade it live, but we're talking about things that we can do in the future that we know are best practices that we can focus on, build out a set of rules, try to have some criteria in place. Well, I don't know about for the whole week, but certainly for the single day, absolutely makes sense. So, for those watching the replay or not being able to see the chat, the question was if we snap fibs on yesterday and we're looking at that halfback, expecting price to get above it, is that valid? Well, yes, absolutely. And it's what we need, right? Because if we don't get above it, we're going to retest that low. That's our structure, and we really need to have that. Now, if we get above it today and close above it, then we need to keep it on Monday, and then we need to keep it on Tuesday, Wednesday. We need to keep it every day. We get below that, and there's big trouble. The next level, if we do get below that, is this low. that simply 65.50. I wouldn't even get down into the nuts and bolts. I would just say 65.50. If 66.70 doesn't hold, 65.50 is where we're going, and that needs to hold, or we're going to the next level lower, which is 64.50. So not just next week. You're on the right track, right? But not just next week, but completely. It just straight up needs to hold or else. Now I say or else, but that's not fair, right? It's not fair to the market because I mentioned this in the morning briefing. We could come up here and we could fail and we could stay here and do this, right? With some wicks below and wicks above and wicks below and wicks above. So we could just hang out there, kind of like that little wick where we wicked it down. We could do that. I guess that's fair. But if we want to continue to go up, we got to get above that level. We got to get above it. So every day when you go to trade, start with where are we? Are we inside of our own price action? And I'm going to start with 10:30 because I know a couple of my clients, they work until after 10 in the morning and they can't get to the charts. And then some like me don't want to trade until after 10. So suppose you just popped up and it's 10:15 and like, yay, I'm free. I'm gonna get me some trades on. Where are we? If we are inside of our own range, then GTFO, you got to get out of that box before you get a trade. At least I do. Why? Because I don't want to trade inside this. And then you want to start asking the questions. If I did want a trade and I could buy one wherever I want, like made to order, custom, where would I like to get a trade? I mean, I'd love to get a trade on a 1, 2, 3, 6 breakout failure off of either side. That would be great. If we can just order one from the trade genie, serve me up one of those. And to me, it wouldn't matter either side. I'll take that. And if we break out and we get through the 2, 3, 6 on either side, then we're probably looking for a bigger move. So I don't like to trade where I find price right this moment. I like to trade where I'm expecting price to go and then seeing it do something that tells me I'm right so I can trade it. If you focus on those as a tactic, it will help you avoid situations like yesterday where the revenge trading, I mean, I don't know, revenge trading, it probably doesn't fit this, but for all the other things, just getting blinded by the tree and missing the forest and continuing to try to trade the bias rather than what we actually had, those sort of things can be avoided by thinking about where you would like to get a trade versus looking at where we are right this second and trying to trade it. There is a lot of reasons to be looking for a bullish trade. Um, Not necessarily to get us back up, to all-time highs and into new highs, but Thanksgiving has had, or the Thanksgiving week has some pretty strong seasonality to it, especially in crude for some weird reason. And then we're going to get into performance chasing and piling in and doubling down. So we're going to see that sort of behavior. We've also fallen a pretty good, decent way in a short period of time, right? That was a 4% move from yesterday's high to today's low, almost a 4% move. In a week or so, it's been like five and a quarter. We've made some pretty sharp moves. Wouldn't surprise me if we start trying to work our way back. But keep in mind what this big red bar gave us. 1, 2, 3, 4, 5, 6, 7, 8, 9. On the 10th day, we finally broke out of it. We could be inside of this bar for a while and not do anything, right? Because it doesn't owe us anything. But there is a difference between these two bars also, and that's that really big tail on the end of this. There was a request to take a macro look, kind of a big picture snapshot, take a look around, see what's out there. And I think that's a fair request in the current backdrop. So on the left here is IWF. Well, I guess they both are. This is not the chart I thought it was. This is IWF. It's growth versus value. It is the Russell growth versus value, but don't let that get you hung up because this ratio is really good for analyzing the Mag 7 and our expectations of tech involvement. I wish I could explain why. I really do. But I can't. It shouldn't be that way. But it's not the first time that the Russell gives us something that we didn't expect from it. So just try to find trust in this thing, even if you have to slowly work your way into it. That when this thing is going up, the Mag 7 is going up, it is outperforming the broader market. And if the Mag 7 is doing good, then getting solid shorts are going to be hard to find, right? If this is sideways, then the market is chopping. It's got a lot of indecision. You could get failures on different market environments, different sectors and industries. And if this is falling, then you definitely don't want to look for long opportunities, right? The lines that you see are just swag levels, previous highs that broke and things like that, round numbers like 230. So they don't really have any special interest other than to myself, right? Like that 218, it was this previous high. That 228 was this high. 230 is just a round number. So right now, we're below the 228, which was this previous high. We are falling sharply, solidly to the downside. We're a long way from VWAP. That's the anchored VWAP for the year. And the MACD, I bet that's a stochastic. The stochastic or the MACD, I'll zoom out and check. To me, I don't care. They're both the same as far as I'm concerned. It's down at the bottom, which means it can magnetize down there. It can get stuck like this and it can just chop about. But as long as it's down there and it's not curling over, it's not pointing up, then we don't have even the momentum of the move for a long. So even if we're looking for a transition to flip this over and go up, we don't have any signal that it's even flipping yet, let alone trying to rise. What is that one, by the way? Yeah, it's a stochastics. All right, stochastics MACD, it wouldn't matter. So we're down here. We need to see these two colors flip and then at least attempt to move to the upside. And we need to see price turn around, either build a base or V bottom and start running. And we don't have either one. And if you look at the weekly, this is kind of good. Maybe, I guess, if you're a glass half full kind of person. Um, they're not down at the bottom and they're not below the midpoint. but they have crossed and we are back inside the 80 and they're pointed to the downside. And all of that is very negative. But we could just be looking to set a lower low here and it could, come down and set that lower low and then it could come up and set a higher high and turn it all around. We don't know yet. Looking at the weekly, unless we V bottom, there's no indication here that we're done going down yet. So from a ratio point of view, this says the Mag 7 is going to continue to underperform. And until the Mag 7 is at least performing equal to the broader market or carrying the broader market, then broad market rallies are high risk, dangerous trades. And all that comes from the ratio IWF to IWD. I like it on a daily and a weekly to kind of get that bigger picture perspective. This is XLY to XLP. It's often called the flight to safety indicator. So, in bad times, people rotate out of risky assets and they'll get into quote less risky things, slow, boring dividend kind of stuff, value over growth. And that's really what this perspective is focused on. When when value is doing better, this thing goes down, right? So staples are outperforming consumer discretionary stocks. But here's the rub. They can both be going down. Staples is just going down less collectively. We can see the MACD is below zero. The lines are sharply pointed to the downside, and there's not even the hint of it curling over yet. So this would need to curl, cross the two lines, cross zero to the upside, and start to rise. You could even look for a higher high, but we don't have any of that yet. I will put a little asterisk in and say that um, in the big picture, there is a problem with growth versus value right now, simply because of utility stocks. But utilities aren't in this per se. I'm just throwing it out there that the whole dynamic is broken because we need energy for data. And it's such an extreme that there's so many markets that are disrupted by this. So it isn't going to really bother this exactly, but just keep that in mind. As a destination trader, where are we headed? To VWAP. Always to VWAP. Same with the last chart. If we continue to fall, where are we headed? To VWAP. And then we'll see. When we turned back here, where did we go? We went to VWAP. And when we turned here and we started to fall, we went to VWAP. So does it have to go to VWAP? No, it stopped here, right? It started to fall and it stopped. It didn't go to VWAP. So it doesn't have to, but that's that's what we expect. Go to VWAP. We also just got like a 1, 2, 3, 6. And so we're getting a little bit of a bounce here. At that point, we could OCC and update it. If I turned it on candles rather than lines, that was probably an OCC, but that's our pullback. So 786, we're not back through that level. And so we don't know if we're going to run up and hit our head and go back down, or if we're going to sit here and digest this, or if we are running a V pattern and we're running back up again. We don't know yet because we're just getting the turn. But we turned where we were supposed to. So that's always good. Price behaving the way it's supposed to behave. It's when it misbehaves that it starts to freak me out. So this also confirms what the other chart said, that growth, which the Mag 7 is the textbook image of growth, growth is underperforming value, value is dominant, or is losing less, which is a flight to safety signal and an indication that the market has no appetite for additional risk. As if you didn't know that by taking a look at Bitcoin. If they're selling Bitcoin and they won't take that risk, why would they take any other risk, right? They don't want risk. They're dumping it. We're going to see this on every page. So it's a nice reminder, I guess. For years, I used to update my TradingView subscription on Black Friday. Every year I did it on Black Friday for a long time. Then one year I doubled down and I got an extra year because of something else. I changed my subscription and now I'm like a year and a half or 2 years ahead. And I don't know. I don't need this one now, but it's a really good deal and it's not bad. It's probably why I'm going to pick up tick charts because it's just driving me nuts not to have my tick charts on TradingView. I do enough trading there that I'm tired of not having it. All right, now this one's a little nuanced. It's kind of weird, but it's a homemade one, and I didn't make it, but the person who did is rock solid, rock star, and it's a really great chart. You can't get this one on TradingView or on Thinkorswim. You got to go to TradingView for it. It's US 30 JP 30. Now, when you type in US 30, it's not going to give you what you're looking for, right? Or it's going to give you multiple choices. Let's say it that way. So if I just use US 30, it's going to look like that. That's US 30. Dow Jones Industrial Average Index. But if I type in US 30 again and I look, there's US 30, Dow Jones 30, and there's all of these, right? Then there's JP 30, LSEG government bonds. So now we know, oh, we're supposed to be using stuff that is 30. So like the US 30 bond, not something with the Dow Jones in it, right? And we didn't have one that had a Y. So we're not using the JP30Y, which means we would be using one of these two, right? But we know we don't want some Luxembourg CSA percent thingy from 2027. So that leaves us with JP30. It's Japan's 30-year government bond. Now that we got the Japan one, jump back to US 30. We're looking for US 30 and we know it's bonds, right? So jump over to bonds. There's the US 30 government bond. Okay. Now I'm going to just paste in what I had there again. If you want to build it, US 30, and then go back in there and add the minus sign JP30. It didn't just leave like I thought it would. So that's the US 30 JP30. Let me check hers. I think when I showed this once before in a live stream, we got my 30 broke. So let me see that I got the right 30. Pretty sure we got the right 30. I'm really confident, but you know what? Check anyways. How you doing this week? Did did you get a hold of some of that yesterday? Redna, I have not shown it yet. I will. Um, well, it's good to hear that you're not at that point anymore where you're stressing the miss, right? I think we were all there at some point where we're just like, "Oh my god, I missed what a beautiful day and I wasn't there." Ah. No, I agree with you. If it's going to tie up my capital, it better give me something. Otherwise, I'm not going to tie up the capital. It's not even worth bringing on the extra angst. I agree 100%. I'm looking for a chart and it's driving me crazy because I'm not seeing it. Aha. I will just log in and see it if I can't find it in the saves. I'm running on the other computer if anybody's wondering why you can't see what I'm doing. I run two computers. Yeah, right. I think it's the right one. I really do. I think earlier when we were looking at the other one that I had bumped that wrong, that 30 wrong by showing it, and then I deleted it and posted the wrong one. Because now when I go in, it doesn't say BlackRock. It says Capital, capital.com. That's the right one. That's what it's supposed to be. So now we'll update these others. Oh, they're good. It did. So it was just that one that was off. Good, good, good. It was the 2 hour that was broken. So this one, while it is weird, is really helpful. This is US 30 bond versus JP 30 bond, and it moves really well with the market. Now, what I want to focus on for a moment is this one here. This has the SPX in orange, the QQQ with that sort of a cyan color, and then in blue is the ratio. So you'll notice when I say they move very much alike, that it's just like that. It's not like the VIX that goes opposite. So it's moving in the same direction. But you'll find divergences in here, and the 30 will break before the others a lot of times. So you'll see the blue one top out, roll over, and extend oftentimes before the S&P and the Nasdaq does. And the extension, while it goes longer to the downside, will often outrun them too to the upside. So this is a good one to watch. Now I use three charts with this, right? I'm zoomed into this one, but I look at all three of these. And what I've been watching for is this longer term trend line. We're going to do that one on this one all by itself. We had this longer term trend line. See if I can put it back. I deleted it earlier. Yeah. Where we broke down. And if you do it, trend spider style, you could have that one there and that one there, but you'll see it doesn't matter, right? It's close is close enough. So we broke underneath that trend line, and then we buzz beat off the bottom of that trend line right now. If we don't get back above that, then we're going to head down, and the next stopping point is down here. I wish I had a correlated market state to kind of highlight what that would be for the S&P and the Nasdaq, but we kind of do, right? If we go back over to this ratio chart where they're all three comparison chart, excuse me, not ratio chart. We go back to this comparison chart. The bottom of this would be the bottom of the SPX here and the bottom of the Nasdaq there. So that's my 55.50, I believe, for the SPX. Probably. It's the October 6th low. So, go over to at yonder. The October 6th low would be, oh, a little farther away. Yeah, that new prime minister, somebody called her the female version of Trump. They said it less gently than that, but you get the idea. And she brought her friend with her, right? I can't pronounce either one of their names, but when we got a new prime minister, we got a new finance minister too, and both of those ladies are the cause for Japan deciding that it's going to spend its way out of debt. And they're taking on billions and trillions of dollars of debt, right? That they're spending. Yeah. No, heck no. It fits right in with what we're talking about. Watching Japan is a really big deal. Before I go too deeper into those macro charts that we were talking about, I did mention that we would cover how to use a big bar. It doesn't matter if it's bearish or not, although that is the bearish bar is the request, but it doesn't matter if it's bearish. It just matters that it's a really big bar. right? And you can use this on any time frame, which means if you get a 5 minute open and it's some big, massive 5 minute open, you can use that, right? You can use any bar. If it's crazy super tiny, that bar has something to tell you. And if it's crazy super large, that bar has something to tell you. So when we go to use these bars, we first want to see what the bar has to offer. You got open, high, low, close. And I know I get it. It sounds very obvious. Like, no kidding. We always have that. Yes, you do. And open, high, low, close is very valuable, way more valuable than people give it credit. Outside of that, we have the midpoint and how we can use that midpoint as a bias for everything else that we're doing. If we're bearish and we mark that mid, staying underneath that bearish mid has a lot of implications. We can't get bullish in the broader market if we can't get through that midpoint. We can't see even the test of bulls unless we've gotten through that and start challenging them, right? There's so much that goes into just where that midline is. Are we able to get close to it? Are we even able to touch it? If we did get through it, were we able to keep it or did we fall back down again? What sort of trading did we see when we got there? Did the tape accelerate? Did we start to get size? Was there any blocks or sweeps that came through, pulling and stacking? And what was the time and sales looking like? Try to apply things like a volume profile. If you're looking back, say the bar was yesterday, apply a volume profile to it, even multiples. You can do the one for the Globex itself, you can do one for the trading range. And if that bar ran the whole day without ever consolidating, then you can run one for the whole day. But if it did consolidate, you can put another profile on in just the consolidation area. Why? Well, because we're trying to understand what the move was yesterday, not just from it went from point A to point B, but did they try to defend it anywhere along the line? Did it stop, consolidate, digest? Did they try to reverse it and it failed? Because when they try those reversals, they don't know if it's going to work, right? I mean, I know it looks like they're in control and they can give it a nudge, but they don't know once they nudge it if the nudge is going to work or not. They have to let it play out just like we. So we can see, hey, did they even try to nudge it or did they just pile on and just continue to dump the darn thing? So we want to take that bar and get as much information as we can out of it. Yesterday's price gives us today's floor pivot. It gives us the volume profile of yesterday, and then, of course, the multiple profiles that I just mentioned. Then it gives us the half back and the open and the high low close. And after all of that, it gives us the 111 and the 1236 on either side, so that no matter which way we break out, we can see where the reversal is going to fail if the fake out, if it's a fake out breakout, right? All of that from a single bar. Now, if you're like me, you don't want all that information piled on it all at once, right? Which is why I have the multiple charts on Thinkorswim and I put a little bit of that on each one of those charts. One thing to note is if you do snap your lines on it, a big bar was made with high volume and volatility. It will very often, if it does not reverse in a fake breakout, it's going to go to the half. So you want your half and your holes. And that's not one of my logics. It's candle reading 101. Nearly every single candle book that I've ever read talks about how price behaves when it breaks out of a range. And now, sure, they're talking about multiple candles, multiple days or weeks or months of a range in those books, but range is range. And what they talk about is if you have a range, cup and handle, head and shoulders, rising wedge, whatever the range was when we break it, measure 50% and measure 100%. I don't do that for a lot of things, but when it comes to a high conviction candle or a high big bar like these big ass bars, use the half and use the whole. If it doesn't give you a fake break fast failure on the 1, 2, 3, 6, it's very likely going to hit that half or that whole before it stalls. And the reason I zoomed back to October 13th is because that was the other really big bar that we had. And it gives us something to use to say, what could we expect after we get a really big bar like the bar we had yesterday? This is what we could expect, that we could chop around inside of it, struggle at that halfway point for days. Look at those big wicks on each side of that 50 and how we just kept dancing there until finally somebody won and we went to the upside. But where did we stall? At 50%. So we can take all of that, and that's just one example, but we can apply that on, a lot of big bars throughout history. But we can bring that over to what we have right now. With what we have right now, we've got yesterday's mid, so we can mark that out, the open, high, low, close, and of course we can mark those out. Um, we talked about the 786 in the pre-market because if this was just going to come down and pull back a little bit before going lower, then 786 would have been that rejection point, and it didn't do that. So now that we're above 786, that opens the half. That says, hey, you can go to the half because you got through 786. Okay, well, we already did the half. Now we got to get above the half. Once we get above it, we got to keep it. Otherwise, all these levels are below us and we get to run those. So you got volume profile, point of control, open, high, low, close, 786, 111s, halves, holes, all of that from one bar. Right. 1, 2, 3s are reversal points. So if it rejects a 1, 2, 3, 6, then we anticipate prices coming back in again. So right. Well, I mean, any line, right? Any line is always a potential reversal point. But 786 sets us up for a flag play. If we were going to continue lower, 786 was the line. So 786 wasn't a rejection of concern as much as it was a tell for continuation. Think about how price got down there. I lost my drawing tool. We fell down. Now it's back. All right. So we fell down, and on the bounce back up, 786 now comes into play because we're bouncing up. If we're going to continue to the downside, 786 is where we expect to reverse and continue that downward move. Once we didn't reverse there and we made it through, that gave us validation to go for the 50. If we had gotten through the 50, then it gives us validation to go back to the starting point. That logic works for anything. It can be the first 5-minute bar of the day. It can be an event bar at 8:30 in the morning. It can be last week's bar. It works on everything. Yes. Think of it this way, and this is what I was showing when I said that. When we get a breakout, we're supposed to stop at 1236. Remember that day I was showing my Fibonacci extension dynamically where we would move it and it would go there and then we'd move it and we would go there and we'd move it and we'd go there. That dynamic fib placement, price continued to stop at 1236. And then we would get an opposite candle and we would move it again. And then price would go to that one and we'd get an opposite candle color and we'd move it again. Well, to do that, we have to have price continue to stop at 1236 every single time we do that. If it overshoots our 1236 and it just keeps going, what does that tell us? The market is so aggressive that there was no take profit, that nobody took the other side, that it just kept going and going. Now, you can say, okay, well, I'm going to buy puts there because it didn't stop, but it does not say it's going to continue in that direction for the rest of the day. That isn't the read of it. The read is, wow, they were so aggressive, nobody even took profit. The reason I'm pointing that out is that's usually what a capitulation signal looks like as well. Capitulation is that blow off top or the last hoorah to the downside before it flips. So if it overshoots after you've been dynamically moving the line 3, 4, 5 times, and then number six time it overshoots, it's telling you that that's very likely a blow off top. But if it overshoots on the first shot, then yeah, that's a read that we're probably going to continue in that direction because nobody even bothered to take profit. We're just running. So here I went into the past and found a day where dynamic fib placement fits. This is a day where we ran all day to the upside, but we actually had real pullback. It got to 1236. We got an opposite candle color, and we would have been able to update our drawing. When we got there, it overshot and it didn't even stop. Well, I'm not drawing it wrong. It actually just overshot. They were so aggressive, nobody even took profit. So then we sit out and we say, okay, well, I can't update the drawing until I get an opposite candle color, which we finally did right there. So now I've got an opposite candle color. I can update the drawing. It pulls back, but never breaks underneath the 786. Where's the next stopping point? 1236. What happens when we get there? It stops because that's what it's supposed to do. We get opposite candle color. Now we update the drawing and we got new targets, a 1236. We got the 786 as the pullback level. It doesn't even get close to 786. Rounds over, makes a run, passes through the 1236, but overshoots it. So we have to sit out. We can't move the drawing because it overshot our drawing and we need the OCC. We only had one extra candle and then it stalled. So then we could move the drawing up. But that is a warning when we don't get that opposite candle color that, wow, they were so aggressive in that move. We didn't even see profit taking. And if the next candle and the next candle and the next candle and the next candle are all the same direction and you never get an OCC, that is constantly reminding you that, yep, they're really aggressive going in that direction. Nobody's taking profit. The trigger to get the put, I guess, should not be that, right? You should already have a bearish bias. You should already have a bullish bias. And if you're looking for a trigger to get the put, probably want to use something like the pullback that I was talking about earlier, some kind of candle signal, or just the bias. Puts are a lot easier to trade than futures because you can just let it ride. The put price is the absolute total loss that you have. When it comes to futures, the loss compounds for every move, every tick. So we have to be more precise. You don't have to be so precise. Yeah. The thing about day trading with the puts that are, or just with options that are so tricky, is that most of the time in the market, in the indexes, these are mean reverting markets. So they don't usually go in one direction all day. They nearly always try to come back towards the other direction by the end of the day. Mean reverting, waves. If you think about the ocean, there is sea level, and waves go above and below sea level, constantly doing that. And we never know if that is going to be the peak or if this is a taller wave than normal. and if that's going to be the trough or if there's a deeper trough than normal coming at us. But it always comes back to sea level. The thing about the market is instead of it being a straight line left to right, it's usually headed up and we have that wave, or it's headed down and we have that wave. But the constant is that it always comes back to the mean or the middle. In the indexes, if you buy a put and you're buying it when the wave is about to end or it's going to reverse, then it runs that direction for 30 minutes, 45 minutes, and then it flips over. It's a rare day when the S&P or the Nasdaq just runs in one direction all day long and doesn't go back the other way. Yeah, I envy artists. I really envy artists because I have no artistic skill whatsoever, and I see people do amazing artistic work. I'm in awe. I can't compete. Even my stick figures look broken. Joe, I'm not sure if you were asking me questions, but A, I do not use any sort of supply demand language. I find that that just confuses traders. I've never pulled that out of the box and I have no intentions of ever starting it. So you can just take whatever I say and apply your supply demand logic to it. When it comes to fibs, mine aren't necessarily fibs, right? If you don't have a 786, then honestly, I don't think you can fairly call it fibs. And I don't use 786. I threw it out the window. They're not exactly quadrant lines either because well, I'm not running quarters. So these are just some broken, bastardized versions of the conglomerate between those two. If they had a baby, maybe this would be the outcome. They're my levels, completely unique to me, and dynamic fib placement I've never seen anywhere. I built it. So the idea is once we have a range that has been broken and price begins to run, we look for always fail that breakout on a 111. And if it doesn't do it there, it'll do it on the 1236 and then it'll fail. Like today when we rolled over this afternoon, where did we roll over? On the 1236. If I snapped it from here to here, which is all we would have had before that breakout and that run, right? If this was our day, we went from the high of the day to the low of the day. Price came down, but failed to get to the 50%, which tells us there could still be a bullish impulse. It tries to make a run for it with these really big bullish bars, reminding us that it's bullish. Big blowout bar, a little capitulation right there towards the end. Hits 1236, fails to keep it. And now where are we at? We're coming back down. But once we got there, we could have updated after we got the OCC. We could have updated the drawing to this level or here, either one. Now that we're at high of day, we can see that we're breaching the 786. But look at what price did. It fell to the 786, which matches everything that I've been talking about. We stalled out there, failed to come back up. Now we're legging down. And where are we going? Back to the half. The question about what to do to move your lines, your drawings. If you're on Thinkorswim, double click it. Just double click it. It'll pop up with the menu. You can add more levels, more lines, more drawings. When you click it once, you get these two boxes. There's a box up there, and there's a box where I stopped right there. And that lets you know where to grab it so that you can move it and extend it. Because if you don't grab it on one of the boxes and you just grab it all willy nilly anywhere, look, I'm moving the whole thing as a package. That's not what you want. Make sure you're grabbing it on the node so that you can expand it or contract it or move it properly, right? You can see how it's updating the levels when I use the node rather than just grabbing the whole darn thing and dragging it around, right? So on TradingView, it's the same thing. Once you've got the TradingView lines drawn, if you want to add lines or anything, draw it first and then just double click on it and it'll pop up with the dialog box. And again, it's got the two dots to show you what you can do to expand it or shrink it or contract it. Or you can just grab the whole darn thing by not using the dots and you can move the whole thing. But that's not what we want. Add your lines and levels that way, right? Most brokers nowadays have a fib that allow you to move it around and add your levels to it. So double click works really well, right? It's worth learning what the textbooks say about fibs and quadrants, but I made my own system because I really felt like the textbooks let us down. So I just developed mine from scratch. And of course, it uses logic from all of the people in front of me throughout history, but it's completely unique. And if you've missed those videos, we've covered them in the past, right? They're videos in the replay section because obviously nobody would know how to use it if I haven't explained it somewhere before. So I've gone over that. I'm trying to write a book on it, but I can tell you that's just not easy and there's not enough time in the day to cover it. So we did go over the big candle. Um, it doesn't even have to be a big candle. Any candle can be considered a range and any range can be measured. And from that measurement, we can get floor pivots and point of controls, value area high and low, and yesterday's high and low and close, and all of that. I highlighted this little section because this was another example where we had a level, right? It was from that low to that high. And at the time, this is all we had, right? So that's all we would have measured the intraday range. Price failed to get above the half. And when it broke down, it stalled on the 111 and that was the low, right? It failed to get through. Reversals fail on the 111 a lot. Not always, but man, if a breakout's going to fail, that's my phrase. If a breakout is going to fail, it's most likely to fail on the 111. If it doesn't, watch that 1, 2, 3, 6 because that'll be the next place it fails. And if it gets through that 1, 2, 3, 6, we're probably not going to fail at all. We're probably going to move in that direction. It's going to be a real breakout. It's going to be my legacy, I fear. Out of all the good stuff I've come up with, that one's going to be the one that haunts me. If you look at the other side of the same example that I snapped, later that day, we went up and tagged the other side too. But we would have updated the drawing at that point, right? We would have had a different low. And so we didn't quite get there if we did it that way. But I mean, it's still there. We fail at 111. All right, so let's jump back into this big picture point of view of the market. We were on US dollar Japan at the time, and I was validating that I had the right one. It should say capital.com on there. We're looking at US 30 bond versus JP 30 bond, not with a backslash, but with a minus sign between those two names. Right now, I've got the S&P and the NASDAQ here to see how they correlate with this. This is a comparison chart, not a ratio. And we are comparing the ratio to the other indexes. When I get out of it, I tell you guys, I watch this one on an intraday basis a lot. I like my daily and my weekly, but it's the intraday one that I really pay attention to. And I'm just looking for big swag levels. My fibs work really good on it too, but angular support, angular resistance, lines and levels that are broken, they're really helpful on this time frame. So I got it on a 2 hour. You could go as low as 30 minutes, maybe. I don't know. 30 minutes might be cutting it a little close. 1 hour, 2 hour, 4 hour is good. Of course, daily and weekly. If this is headed down, so's the market. If it's headed up, so's the market, or at least that's our expectation. It doesn't have to because price can do whatever the hell it wants. We don't want to see trends in this. So lower highs and lower lows trending, that's bad. We don't want to see big fast moves either because that means the market is making lower highs, lower lows, and big fast moves. So that's a really good one to keep. Right now, we broke a trend line, a really big, important trend line. We're underneath it and we are bouncing into it from below like a Busby, but it's not good, right? It wasn't good when we did it here and we thought, oh, that's bad. And then we popped above and we're like, yay, they saved it. Shoot, no, never mind. So now we've got that lower high and it's not good. And this also says we should not be looking to short the broader market. So we got this that says the Mag 7 is underperforming. We've got this that says value is doing better than growth, which again is like the Mag 7, but also just your tech and pretty much everything that carries the broad market. Value is outperforming growth, even though technically they can both be down. And then this is kind of my own little bastard version. There's all these new ETFs and ETNs that even though I don't necessarily want to trade them, I think they offer amazing value for an open-minded analyst such as myself because I never bother to ask why, just why not, right? So why not put these two together? It's the Mag 7 and the Top T. The Top T is the top 20 names in the NASDAQ, and of course, the Mag 7 is the Mag 7. If they, how can they work together is kind of my question. And so I threw them together in this ratio, and they're both new. You can see that we only got like a year of data. So we don't have a lot to work with yet, but I watch this. I look at it every day. We broke that key level, Busby'd off the bottom of it, and now we're still headed to the downside. Even in this pullback right now, we haven't managed to get past this lower high yet to set a higher high, and we're still making lower lows. We're in a full trend to the downside. Lower highs, lower lows, this thing's on a mission, and it hasn't turned back. We can't look for broader market participation to go long if we got the top 20 names in the NASDAQ outperforming the Mag 7, which is what this is telling us. Because remember, the Mag 7 can dominate 493 other stocks and bully them. But right now, the top 20 names in the NASDAQ are bullying the Mag 7. So we don't want to go against that. And the trend is down in this. So we don't want to try to look for longs. Just another reminder about Black Friday there. This is a pure tech chart, and it's a big picture chart. It's always on the monthly. IXIC is the full NASDAQ, not the NASDAQ 100, like when you're looking at the QQQ, right? So it's the big one. This was one that somebody made, and so I just use what they use. I don't know why they don't just use the NDX, but I don't want to argue with them. IXIC, we can see the range, the channel that we've been in since 2002. We had that brief expansion out through the top, and then, of course, in the bear market of 2022 when we got out of the bottom. But this is the monthly bars, and I play the same swag levels, the same fib, and the all the candle talk that we focus on becomes really important on a monthly bar. I can't tell you how valuable that is as a swing trader to focus on monthly bars and the high open, high, low, close. You can save yourself a lot of loss by going out to a monthly bar and looking at where price is now compared to last month's single, just those two bars. Where are we at and where's last month's bar at? There's so much hidden information out here. And I say hidden because if you don't look, you won't find it. But if you look like a little Easter egg hunt, you'll find it. Well, right now, this isn't giving us any good information. We've got an outside bearish engulfing. One of those words don't fit. So either outside or the bearish engulfing. It's an outside bar to me. It's not bearish engulfing yet, in my opinion, but we're splitting hairs. This candle went outside of both sides of the previous bar. That's the important part, and it's bearish. So we gapped up, failed against resistance, the resistance being the previous month's high. We rejected there, and we fell all the way down and broke the bottom of last month's low. Now, at the moment, we're back inside the box, but just barely inside the box. If we continue to fall, we're going to hit the 10-month. Not on this chart. Yeah, we're definitely back inside the box, but whether or not it sticks remains to be seen. The I gotta change my bandages soon. The 111, 1236 would probably have fit for the how far did we expand on the breakout? And it is a little bit of a surprise that we got that close to the 10, but we didn't actually hit the 10. We didn't actually hit the 1236 either, but we got darn close to it. So I don't like that reversal. It didn't reverse off of any structure, and we way overshot that 111. If we were going to fail 111, we should have done it closer. And if we were going to fail 123, then we should have got there. And we didn't do either one of those. So I don't trust that reversal. I don't like it. And at this point, it has to get back above that 786, or we can just roll over and continue to move to the downside. This monthly bar has a week and a half left, right? Well, I mean, once you cut out all the days that are left to trade, there's really not that many days left in the month. One, two, we got 3.5 next week, and that's it. 3.5 days is all we have left. I thought there would be like 6. Nope. So if this bar closes outside of last month's bar to the downside, that's going to be really bad. But also, it's red. And it's been a long while since we've had a red bar, all the way back to April when they bent Trump over the barrel, right? When those bond vigilantes got a hold of him. So a red bar by itself isn't too bad. And it's at the rejection point that we had already expected. That's a bigger 111, 1236 fail from this high and that low. Yeah, except we didn't get up there either, did we? But that's more common. So I use this. This is my tech gauge. Should I be looking for long opportunities in tech stocks? If this is negative, if it's going to hit key resistance, if there's negative patterns or signals, then I don't like going long in tech stocks. For an example, when we had this wiki area here and we were coming into it course, we needed this and we needed this to be risky here. When we were running up into it with such dominance and strength, I started getting out of stuff before we hit that box. And I'm not saying I dumped my whole portfolio. It's not like that. It's just that I started closing out stuff that was in profit well, or things that weren't kind of working out that good, maybe things that were new. I reduced my risk before we came into that box because I was worried that we were going to just tag it and drop. I mean, we didn't. We cut all the way through to the other side, but I didn't know. Like, I lost my crystal ball that I just didn't know we were going to go all the way through the range. The point is, this is a good chart to keep your eye on for what to expect out of tech stocks. And of course, we all know that tech is dominant in the market. If tech is weak, the rest of the market is going to suffer. I don't use this on any other time frame. You you could try, right? Because making our own thing is always something that I encourage. I've never had a reason to, so I don't. If you did, then give it time and make sure that you can validate your work. That's the best I got for you. Otherwise, just leave it on a monthly because it has a lot of value on this time frame. You could even put it on a log scale on a monthly. I don't see anything wrong with that, right? It's going to make your channel look a little weird, but nothing wrong with it. This channel started all the way back at 2003, and this is a Linreg line. So what you want to do is use the Linreg drawing tool, and it'll take care of the rest. All you do is tell it what day you want to start and what day you want to stop, and it'll line it up for you. Somewhere in that mess. Regression trend right there. Use the line at the top, and if you're on Thinkorswim, it already has the regression lines, right? On Thinkorswim, it would be that tool right there. The line just updates on its own. If you draw it to the end, every new candle, it should update for you. If not, then just grab it and drag it one more forward. And from the starting point, there's no reason to change the starting point unless we were to fall over and like change the range to where this entire structure was headed down. There's no reason to change it. Not on this time frame. I'm measuring this run. And until that run no longer exists, I'm not going to get rid of this drawing. I didn't update that. Now it's updated. Now, individually, you can run Linreg just like we run fibs. So I could start one here and stop one there and run a Linreg for that if we were in that move. The other way around, you could start one here and end it where we are now and run Linreg through that move. Because why not, right? Like, the whole point is to see where the swing is. Like we were talking about with those waves or the bunny slopes at the ski resort, it always comes back to the mean. So if you're having a hard time seeing the mean, get used to using a Linreg tool. It'll help that, it'll spot it for you. All right, so now we're looking at IXIC again. which is the NASDAQ composite. We're not using the QQQ or the NDX or the NQ. We're using that big one. And the white line that you see behind it is the cumulative volume index, the CVI. Thinkorswim has a CVI as well, um, but you don't have as many choices on Thinkorswim, right? So cumulative volume index, I'm going to just double tap that indicator and open it up. It asks, hey, what exchange do you want to look at? Would you like the NYSE, the NASDAQ, ARCA, US Total? And US Total is awesome. Not for this chart, right? But in general, US Total, that's really, really, really cool. But for this chart, since we're looking at the NASDAQ composite, you want to set it on the NASDAQ and hit OK. So we're looking at cumulative volume, right? If net buyers are in control, this thing goes up. If sellers are in control, this thing goes down. And that's just a very simple way of looking at it. Well, look at this sell off that we've been getting since November. Look at all that selling, and the indicator just stalled out. It didn't fall. Now, granted, it didn't go up really, but it didn't fall. Here's the daily. We topped out in the markets in the first week of November, and we've been falling ever since. We're still holding that range here. Now, sure, it's finally starting to go down just a little bit, but we just this last day or two, we just broke that low. Now, finally, after all this. And if we focus on the low before the rollover, it's all the way down back here. I got to stick it out to make it work. And we just barely broke down out of it and we're back inside it already. Right? That's frustrating. See, and I don't that's the salty part. I don't like paying $200 for a tick chart just because it's a tick chart. Those dirty dogs. Yeah, I mean you can use the QQQ, you can use the NDX, the NQ. I don't care, right? It's still going to work. I just use this because this is what I like. I don't want to use the abridged version with only 100 names in it. I want all of them, even the dirty laundry ones, right? Even the ones that are underperforming, because I want to see what the entire index is doing. This isn't about futures, this is analysis, right? If I was worried about trading it and trading the NASDAQ in the futures, I wouldn't look at this. I need something else because this is big picture. And if I'm trading, I'm aware of the big picture, but I'm focused on the little picture so I can get signals to get in, get out, protect, defend. This is just, hey, what the heck is the market doing out there? Should I be long in my portfolios? Should I reduce risk, double down, get the heck out? And in the broader market, the broad NASDAQ composite, the full dog, is broken. We're in a downtrend, and yet we don't have dominant net selling. We've got this sideways, sort of stalled out market. Not bearish, just not bullish. Not even broken. They're not liquidating. And speaking of not liquidating, did you guys see that flow report that I posted this morning? It was a PDF document. Oh my goodness. If you didn't see that, you should scroll back and take a look at that. Let me post something that I wrote that tied into that. Now I had a little help writing this with the AI. So, you know, you got to do a little bit of your own DD. But let me share something that I wrote after this. You know, yesterday in the indexes, it was crazy bullish in the indexes yesterday. Did anybody feel that it was crazy bullish yesterday? It was. You think I'm crazy, don't you? You're thinking it right now. Sig done fell off his rocker. I took a picture of the top of that PDF document that most of you probably didn't open. Let me put that picture in the chat here. For anybody watching the replay, let me bring the picture over so you can see it. QQQ, extreme bullishness. The Qs see extreme bullish delta. That was this morning. I posted this. They're talking about yesterday's price. Do you guys feel that the Q was extremely bullish yesterday? Me neither. So don't feel bad. I was trading it like you guys. I was in the futures. I was trading it. But if I had called timeout and was looking at the options, this would have stood out, right? But I wasn't looking at the options yesterday. I was just straight up trading price, getting what I could. Got the insurances to pay for and all that good stuff. So I was getting it while the getting was good. But that write up that I posted, that was just the first part of it, right? And that's today's work. Here's the rest of it, by the way. It's a lot. So I'm going to put it inside that first post. I'm just going to make a thread out of it so that it doesn't spam the chat. And then you can just click on that to go in and read the rest of it. Now I'm going to remind at the bottom of that post, wrote with AI in collaboration. So do your own DD, right? But that analysis out of that flow patrol was pretty awesome. If you didn't have it, this chart told you the same thing, that they're not liquidating, that they're still bullish in the broader market. Are they profit taking into a long weekend? I thought someone said they were selling off really hard right now, but I don't. I guess I don't see it. They're selling off into a short week. Next week is a short week. That's why we use that phrase. This was a regular week, but they're selling off in front of a short week because next week is a short week. 3.5 days. It's one of the shortest trading weeks of the year. Usually we get 4 days, but this week coming up is going to be 3.5. So this chart, to get back to the macro here, says that while things are negative out there in the S&P, the Dow, the Russell, the indexes, big picture, they're not dumping their holdings. The good thing about seasonality or trying to extrapolate what we think it's going to do next week, is there's this thing called the Trader's Almanac, and it's pretty darn amazing. If you don't own a version, because they're not free, just ask AI questions about the past, right? It won't have, oh, awesome, you've got the new one. What's it say for Thanksgiving or this part of the year? I'm sorry to put you on the spot like that, but inquiring minds want to know. I hear you. If you could find it at some point, just point us in the right direction. Not today, right? But say like between now and next Wednesday's stream, that'd be pretty awesome. Because it's easy to have a selective memory about what our expectations are, right? When it comes to um, what happened last year or what happens during FOMC, and then we actually go and look, and we're like, wow, I guess it wasn't what we thought. I think we might have to, right? We might have to do it on Tuesday because the short day on Wednesday, and nobody's going to be here Thursday. Or the I don't even know if I'll be here Friday. Right. I'm gonna say now that I won't be here Friday. That way, if I surprise everybody and I am here Friday and I announce it Friday, then whatever. But let's just say for now that I won't be here on Friday. Then nobody will be disappointed if I'm not. So thank you for hopping in. Have a good weekend, and let's see you next week. What's up? So this does highlight they haven't sold out, right? That's what we keep this one for. You got it on Thinkorswim as well. It just doesn't have as many choices. This is what I use for the Fed and their plumbing. Think of like overnight repo and what they always talk about on the air, like Bloomberg and stuff about, is there liquidity? This is the liquidity gauge. We are liquid if it's low, we are illiquid if it's rising. So, risk or danger is if this thing starts going up. It's a really long symbol, but it's ICE Bank of America US High Yield Index Options Adjusted Spread. Blah, 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 blah. Just copy that and paste it into your trading view. So, pretty simple tell. It is a mouthful, absolutely. I think there's different versions of it too. If you just type in, Bank of America credit spreads, I think you'll get like four different versions, but they all kind of look the same. So I wouldn't split hairs on it. But with this one, you can see what we did in April when the market sold off kind of hard on all the tariffs and everything, and then we pulled back. So we had some liquidity issues back there. And you can see where we are right now. There is risk compared to the lower area here, but we're not yet breaking out. We're right on the edge of things getting kind of nasty. So they're not nasty. But if we break out here, we got to expect that they're going to get nasty. And the next stopping point would be that previous high, that 3.4. And that's how I use it. I just look left and find these pivots and then I mark those out. We don't want this to put in a base. We certainly don't want it going higher. You could absolutely. I think that overlaying it with the SPX would provide a nice visual. I keep mine nice and clean, but if you overlay it, well, let me change the color at least. If you overlay it, it'll help you try to see how negative it got in the market when this was going up. Same thing back here, we got negative, right? Or here when we had that solid dip and it was just this pullback in the market here. So that run up was that drop, and then that drop was that run up. So yeah, it can help while you work on getting more comfortable with it. It is a daily indicator, so it should only update once a day. It's a good question though, because some of these tools they update like 3 times a week. And I mean that's not awesome, right? Like if you look at the move index or the volatility of oil index, those don't update even every day. They're janky. Like they'll, I don't even want to say that it's a regular every other day because it's not even that. It's just they update infrequently. So not really good. But that one, it does do a good job of supposedly updating every day. As long as the bond market was open, it should update. So I do like this one, and it is indicating that we are looking at some risk. But as long as we don't break out and close above that, and the market is now closed, so we didn't, then we made a reprieve, at least for this week. And we need to keep a close eye on this next week to see that we fade back down and get away from this edge. Because this edge is literally standing on the edge of a cliff, kicking pebbles over the edge. And it's a little too close, a little too close. It's the toss Discord, and I've been putting over some levels, um, some of my charts and my drawings, but by no means have I got them all over there yet. But I have been putting some in there. All right, so this is the move index. As we can see, it's the bond market volatility. Well, I mean, I wouldn't care if we had another bull run. I don't necessarily want a bull run. I want just a good, steady move in one direction or another. I don't care which. I don't want extremes, right? Extremes are no good for anybody. But if the Fed would give us forward guidance and everybody could just calm down and relax and trade a regular market, I would be down with that. I'd be happy to have that world back again. The world we had before 2020 and COVID, when we had a steady Fed and a steady market and steady jobs and everything was just, we're like autopilot, you know? Yeah, but it's going to take time to unfold, right? So, um, a year ago in Europe, they had this new official, and she was in the office for 3 days, and then she said something and broke the gilt market. And boom, we had this flash crash. She got fired. Everything stabilized after a couple days, and it was fine. So we had these two new people in Japan. At any moment, they could say something that flash crashes us just by words. Just they could just make a statement and break something. That's one issue all by itself. Then there's the proposals that they're making that they just ratified actually, and they're passing, that is going to change how Japan functions in the broader market around the world. The carry trade unwind and so much more is going to be affected in ways that analysts right now are still arguing about. And dude, if a 40-year analyst has no idea what the hell's about to happen, we should all be very scared, right? So they don't know what Japan's ramifications are going to be to the global market. The carry trade, as in pick up something and carry it, is when you have a negative interest rate environment or a lower interest rate environment than another market. So, say some high market like Mexico versus a zero market like Japan. That's your carry trade. It's a broad concept that's been around for a long time, and it's a way for like fixed income players to play the spread. But for us, it's a tell on liquidity and money moving in the markets, and all of that is going away. It's going to be some different thing that we don't even have yet. The whole system is about to change, so we should all be very concerned about a what's it going to be, b are we going to break something as it changes, and then three, has there been any sneaky, shady, underhand stuff that none of us know about that's going to come out? Because think about it, when the system gets set into place and people learn how to game the system like they always do, then there's money that is cheating and hiding and it's going into places it shouldn't, and people cheat like crazy. Well, if they unwind the whole system and now money's going to become due and they can't carry that paper loss any longer, how bad is it going to get? I don't know, but neither does, you know, anybody else right now. Like nobody. Yardini is an old man, smart as a whip. He's been around the markets for like 50 years, and even he doesn't know. Nobody knows. So definitely got to keep your eye on Japan because if something's going to go wrong, it's probably going to happen from that direction. Look at their 10-year. All right, this is a daily chart. Look at that big blowout move right there. That's got to be scary, right? So yeah, keep your eye on Japan because if something breaks, it's very likely going to come from that direction. Yardini, Ed Yardini, he's a pretty cool dude. Let me he has a collaboration with this company called Macro Me or Macro Micro. So he'll do interviews with these guys and then they'll write up this big old publication and pass it out to their members. This platform is like Nerds Are Us. You know, it's where we all hang out. Um, and he is also at stockcharts.com from time to time too, because he's part of that crowd. So yeah, big macro guy and really uh, amazing at what he does. You'll hear his name on Bloomberg from time to time when they'll be like, "Yeah, Ed Yardini said blah blah blah, whatever." I was hoping when I came over here that I'd get some big pop up that had his name on it, but I didn't see it. I guess he hasn't had a uh, post this month. Nope, he didn't have one this month. Oh well. You'll find him though. Hit Google or YouTube and type in Yardini. Don't ask me how to spell it. I am horrible at spelling anything. He shouldn't be that hard to find. We didn't get to it, but I've got some charts called the Bullish Percent Index. They belong to stockcharts.com. It's one of the reasons that I like having an account here. They're one of the few places that I know that carry that chart, and we'll go into that next week. We're gonna probably spend a good part of the stream on my stock charts account next week, going into the bullish percent. Now, when it comes to those bullish percents, they've got a gold miners bullish percent, and then they've got one for the indexes. I think they've got one for oil. So they got some commodity ones. It's a really good macro tool. But like I said, I only know one place that's got them, and it's right here. Um, but they have really good signals. These charts, they're fixed. They've been around for a long time. The community at Stock Charts has done a lot of work to share the chart setup, so everybody just kind of uses the same thing. And we'll bring those in next week and deep dive into those. But the takeaway at this point is that yes, we've got a lot of risk saying that the Mag 7 and tech is floundering or is weak, but all the other signals said don't short this sucker into oblivion because we don't have oblivion crashing signals. We just got weak tech and no reason to go long. Not bearish, just not bullish, right? That's where we're at right now. So it might feel bad. It might even look a little bad. We're down some, but the behind the scenes signals are not saying short this sucker. We're not seeing a 2022 bear market. We're not seeing a continuation to the downside. Not in these tools, not yet. And that's what we all really need to know, right? Should I double down and start getting heavy short? I wouldn't. Not yet. There you go. That's the guy, Ed Giardini. That guy is smart as a whip. Just put him on high speed so you speed up the video because he can say something in 30 minutes that should have took 8. And it's funny when his dog gets involved. Like sometimes he's on Bloomberg and they'll be interviewing him and his dog gets in on the picture. It's always funny. Ah, well. Puts are getting cheaper. That's a good sign. Even with the move today, puts are getting cheaper. But we still got the elevated VIX. VIX needs to get back below 22, and then we got to get below 20, one level at a time, right? So, what I'm hoping to see next week, even though it's a holiday next week, and that kind of breaks the whole thing, but read my post because it does talk about next week in what I wrote in that thread right there. But what would be good is if we could get some sort of capitulation low. If we had closed down here, I would have liked it better because then we could have gapped down and we could have roared to the upside, and we didn't get it. So now I want to see us gap up above that and then roar. Um, I guess either would work. The thing about the daily pivot is just to be specific on the idea that we want the entirety of the day, right? The daily pivot. If you just say pivot, you could get all sorts of stuff. And if you're going to Google it, just use the word floor pivot because the floor pivot will replace the word daily with floor and your gold. Ed Giardini is the guy that I mentioned. Oh, so in the morning briefing, I talk about the idea that we got this guy out there that has this whole concept about central pivot ranges. These. and missed daily pivots. That's what you want to search for. Missed daily pivots. I think his name is Rob somebody. Rob, I don't Rob something. But he's got videos all over YouTube that talk about missed daily pivots. And that'll help you better understand central pivot ranges and why we expect price to hit that pivot. And then how you can use that in your analysis. Absolutely. Yeah, that's what you want to look for. Now, I don't trade it just to, reiterate, because I know I've said it before, but it's best to say it again. I don't trade the missed daily pivots, but I learn a lot of strategies that I don't trade. I just use those strategies for my analysis. Yeah, when I learned about missed daily pivots, that's where I learned it from. That guy. Because I had never heard of missed daily pivots until I came across that guy. Yep. If you're looking for research, Brian Shannon is a must-have. If you have not seen this guy, find him on YouTube, right? Now he's got paid stuff. I don't buy things, right? So I'm not buying anything he's selling. He's got some books, right? I'll buy books, but I'm talking about like classes or courses or signing up for some. I don't do any of that stuff, right? He's got some really good books, but he's got great free content all over YouTube because he's had videos at Stock Charts, at Tasty, all over, right? All over. He's got some really good books about moving averages and anchored VWAP. So if you haven't come across this guy yet, check him out. It's because of him that we have anchored VWAP on so many platforms. It's because he made it a mission in his life to hound all the brokers to put that indicator on their platform, even if it was a platform he doesn't use. Because he's just like, your traders deserve to have this indicator on their platform. That's pretty cool. So him and Ed Yardini and that Rob guy for the missed daily pivots. All right, guys, it's the weekend. Let's get out there and get after it. Don't forget, short week. Next week, it's going to be 3.5 days. So be mindful of that with your options trades, that they're going to have less time than you think. I really wanted to get a ride in, but I'm a fair weather kind of rider, and I just can't see me getting out there at 50 degrees. Maybe next time.